We're here in Monte Carlo for the Rendezvous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Paul Brand, CEO of Convex. Paul, great to see you again. Welcome.
Lovely to see you again, Richard, as well.
So Convex is no longer a startup. How's that affected your outlook and the decisions that you're making for the company?
Not really a great deal of difference. We've still very much got our entrepreneurial spirit going. The company's still growing quickly. We're still doing interesting things in data and technology. So I think it's more of the same as opposed to a radical change. Don't plan to get too staid and settled down anytime soon.
So tell us some of those exciting things that you're doing.
I think and maybe my view of what's exciting and what other people's views of what exciting might be different, but really pleased complete our finance systems work. We've had finance phase 1, we've had finance phase 2, and now we're starting to see our finance systems be kind of state of the art, and that's a wonderful place to be.
So we're here talking, as we always are, in the midst of the hurricane season. It's a hurricane season that's predicted to be a little bit more active than normal. To what degree is the reinsurance industry prepared for a major loss event?
So I probably more prepared than it was a few years ago, because we've certainly done things in terms of prices and retention levels. But I do still think that the market is very brittle. We went through a long period of time where the industry, particularly on the reinsurance side, had not earned its cost of capital. There's quite a lot of sort of disquiet among investors as they think about the volatility that this segment of the industry poses. And if it was to be a really bad hurricane season, then I would expect to see a lot of volatility on pricing again. I think the industry is very brittle.
So you talked about investor reaction there, investor response. How are investors looking at the reinsurance industry at the moment?
I think cautiously. You've not seen as many startups as you might have expected. There was one that was essentially signaled to be coming back again a couple of days back. And you look at where the prices, share prices of people exposed to this sector are, and then most of them are not. They're not rocketing upwards. Yeah. You've seen some of the better companies have some improvement, but a number are still sort of bouncing along the bottom.
So you mentioned there that the lack of a startup. What are the longer term consequences of not having startups in this segment of the hard cycle?
Yeah, well, I think that you need a supply of fresh capital to the business, and you need people to be able to sort of say that they've got a proposition that is going to work through the market cycles. And if that starts to happen, then the industry flourishes, because you're going to get to a stage where there's going to be increasing demand for risk transference, particularly as we expect there'll be more losses. So I think you need to have an industry which is there to meet that demand. And I think you need to have companies that can grow, and you need to have new players to help that happen.
And new players potentially to offer some solutions to the challenges of the future. Thinking of AI, I'm thinking of cyber, I'm thinking of climate change. How well geared up is the industry for that now?
Yeah, well, I think you can see sort of old players and new players can rise to those challenges. There's a really interesting challenge, though, isn't there, around we need to have that certainty that it's a reasonable proposition. And as you actually look at some of the more esoteric coverages, how easy is it to price for something when it's not actually happened yet? I can remember there's always a lot of focus on contingent business interruption as an extension to kind of coverage that insureds and reinsureds say that they'd really love to be able to buy. And then when you start to see sort of actually some very innovative and very broad products offered, everybody goes, well that's going to cost us too much. It's on the sort of 10 online and not 1 or less than 1, and everybody goes, well, we're not going to buy that. And so the market can get blocked by sort of differences in opinion as to actually how likely events are going to be, and if I'm going, something's much more likely to happen than you think it is as the buyer, well, we're not going to reach agreement and the price won't clear.
So is there a danger there that the reinsurance industry perhaps falls out of relevance, or can they balance those issues?
I think that the more losses there are, the more relevant this industry is, and I think we're in a world where most people are predicting that actually losses are going to go up, and there's more volatility, and there's more things that can go wrong than can go well. So I actually think that it's when you don't have losses for a long period of time that people actually start thinking, well, maybe do we need this reinsurance? Do we need this cover? So I'm not overly challenged by the relevance point today.
Paul, thank you very much indeed for talking to us. Great pleasure as always.
Richard, thank you.
For AM Best TV, I'm Richard Banks.